Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Beijing JINGCHENG Machinery Electric Company Limited Annual Report. Beijing JINGCHENG Machinery Electric Company Limited offers a diverse range of products and services across various industries. At the core of their business are gas storage and transportation equipment, including liquefied natural gas, LNG cylinders, compressed natural gas, CNG cylinders, seamless steel gas cylinders, and ISO tank containers. In addition to these primary offerings, the company also provides a range of complementary products such as filling station equipment, wrapped cylinders, low-temperature cylinders, and ground conveyance and assembly system products. Their product line extends to robots and automation equipment, non-standard automation machine products, and integrated robotic applications and stamping lines. The company's services include import and export trade, consultancy, and other miscellaneous services. Their products cater to various industries such as automotive, chemical, firefighting, medical, petroleum, energy, urban construction, food, metallurgy, machinery, electronics, and more. With a history dating back to 1993, Beijing JINGCHENG Machinery Electric Company Limited has established itself as a prominent player in the global market for gas storage and transportation equipment. Beijing JINGCHENG Machinery Electric Company Limited market capitalization of $6 billion is materially smaller than most of its industry peers of roughly $26 billion. Beijing JINGCHENG Machinery Electric Company Limited trades at a higher price-to-book ratio of 2.78 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be attributed to various factors. On the negative side, a significant decrease in operating revenues by 7.3% has been observed. Additionally, declines in gas storage and transportation product sales, domestic market sales, and international market sales have also contributed to the revenue decline. The cylinders segment has seen a substantial decline of 22% in production and 24% in sales volume. The compound gas cylinders segment has also experienced a decrease of 16% in production and 4% in sales volume. These declines are attributed to intensified competition, downward pressure on export business due to international trade frictions, and decreased demand for certain products. On the positive side, the company's differentiation strategy in the steel gas cylinder sector has contributed to revenue growth. Increased revenue from large-diameter products has also been a significant contributor. The expansion into new product sales boundaries with large gas companies and newly built projects has further boosted revenue growth. The compound gas cylinders industry growth is driven by hydrogen energy demand growth, while the cryogenic industry growth is in its low-level adjustment phase. However, there are no significant fluctuations in the vehicle-mounted LNG cylinders market. Furthermore, the intelligent manufacturing segment, including automation equipment industries such as collaborative robots and medical automation, is driving growth. Net income and profit margins. A tale of two trends. The net income of the company underwent a significant transformation over time. Initially, it decreased from $22,545,179.01 to -$118,117,651.01 indicating a substantial decline in profitability. However, this trend was reversed due to various factors such as improved management systems, technological innovation, and increased productivity. These efforts led to an increase in net income. On the other hand, profit margins experienced a mixed bag of trends. Initially, they declined significantly due to increased credit impairment losses and decreased incomes from asset disposal. However, through cost control, delivery cycle optimization, and product standardization, the company was able to improve its profit margins. Additionally, factors such as cost reduction, technological advancements, and procurement optimization contributed to this improvement. Despite these efforts, net income declined by Rm 134,341,200 year-on-year, indicating that the company still faces significant challenges in maintaining profitability. Furthermore, a decrease of 7.33% in operating income margin and 4.57% in operating cost margin suggests that the company's profit margins are under pressure. The slowdown in infrastructure investment, substitution of liquid supply modes, intensified price competition, and pressure on profitability and survival for small to middle-sized enterprises have all contributed to the challenges faced by the company. However, through continued efforts in cost control, technological innovation, and process improvements, the company may be able to stabilize its net income and profit margins in the future. The company's financial performance indicates a strong ability to generate cash from its core operations. A positive operating cash flow of $4,876,554.69 is evident, as stated on page 26 of the report. This trend is consistently confirmed across multiple pages, including 31, 46, and 47, further solidifying this conclusion. The company's ability to produce a significant amount of cash from its daily operations suggests a healthy financial position. The company's debt level has undergone significant changes between 2024 and 2025. On the one hand, short-term borrowings decreased by $50 million, while total current liabilities also saw a substantial decrease of $141 billion. However, long-term borrowings increased by 13.5% from $133.35 million to $151.59 million. In terms of interest expenses, there is some ambiguity in the provided information. Initially, it appears that interest payable has decreased significantly, suggesting a potential reduction in interest expenses. Nevertheless, further analysis reveals that interest expenses have actually increased, as indicated by cash outflows from financing activities amounting to RMB 327.69 million. The performance of various segments and regions within the company can be analyzed based on the provided summaries. In terms of gas storage and transportation, several sectors demonstrated notable success. The steel gas cylinder sector stood out due to its effective differentiation strategy, which led to expansion into emerging markets and improvement in local operating capabilities. Furthermore, the compound gas cylinder sector maintained its existing market advantages while expanding its market share in overseas business. Overall, this segment achieved stabilized market share and expanded customer base coverage. These results indicate a strong performance in the gas storage and transportation segment. In addition to the gas storage and transportation segment, the intelligent manufacturing segment also performed well. It successfully maintained a stable gross profit margin and laid a solid foundation for future development. This suggests that the company's focus on intelligent manufacturing has been beneficial, contributing to its overall growth and success. Management's vision for the company's future is centered around growth and expansion. To achieve this, they are focusing on three key areas: market expansion, structural optimization, and international cooperation. This approach aims to build on past successes and drive further growth. The industry is undergoing a significant shift towards smart, green, and scenario-driven trends, with an emphasis on upgrading and standardization. Management recognizes the importance of adapting to these changes and has identified overseas business as a critical driver for future growth. The company also anticipates that intelligent products will play a decisive role in its success. To mitigate potential risks, management is taking proactive measures to reduce foreign exchange risks. This includes making preparations to hedge significant foreign exchange risks when necessary. By addressing this challenge head-on, the company can better navigate an increasingly complex and interconnected global market. The company's dividend payment record is evident through various sections of its financial reports. On page 51, it is explicitly stated that the company paid dividends in 2024, marked as yes under the dividends section. Furthermore, an increase in dividends receivable from $3,253,586.63 to $6,837,130.59 between 2024 and 2025 suggests a consistent history of dividend payments by the company. This pattern indicates that the company has indeed paid dividends, rather than buying back shares. Concerns about inventory buildup and supply chain disruption are evident in the industry. Inventory buildup is a pressing issue, particularly in the compound gas cylinders segment, where it has been noted on page 28. Additionally, there is also a mention of inventory buildup on page 44. Supply chain disruptions pose another significant challenge. The cylinders segment is not immune to these issues, as highlighted on page 28. Furthermore, international supply chains are struggling to recover from the effects of global events, leading to logistic efficiency and transportation cost pressures. Exchange rate fluctuations in emerging markets also add to the operating challenges faced by companies. The cumulative effect of these concerns suggests that inventory buildup and supply chain disruption are real issues that need to be addressed. Companies must find ways to mitigate these risks and ensure a smooth flow of goods and services to meet customer demands. That concludes the financial summary for Beijing JINGCHENG Machinery Electric Company Limited. Feel free to comment below, and I will be happy to answer them when possible.